The impact of the coronavirus is spreading throughout the global economy, with many predicting a recession due to the pandemic. But the UCLA Anderson Forecast says that recession is already here. Joining me to talk about the economic outlook is David Shulman. He's the senior economist for UCLA Anderson Forecast. Now, David, I just want to set this up because for the first time in its 68-year history, you guys revised this forecast before it was published. How are you seeing the health of the economy unfold over this year?
To us, the economy was falling off the cliff at the end of February. We had a very bland forecast that we had done, and it was going to basically show 2%, 2+% growth for the next 3 years. Kind of boring, but very, very good right now compared to the excitement right now. And then we saw things falling off a cliff. So we rewrote the forecast once. And we published that forecast, which had very slow growth in the second and third quarters. And then it's like was Wile E. Coyote really falling off the cliff. And we came up with a new forecast. And I'm afraid that that's too optimistic right now, even though we said the recession started this month. And we have GDP down 6.5% in the second quarter and 1.9% in the third quarter. It looks like, at least in the second quarter, it's going to be much worse.
And then, and just in the state of California, which is, the fifth largest economy in the world, how do you see that impacting this state as well?
Well, the thing is we saw things starting to shut down the end of February, beginning of March. And now it looks like the airline industry is 30% load factor. Delta's eliminating a whole bunch of flights. Hotel industry occupancies are falling below 50%. In some cases, major companies are closing hotels. There are all kinds of orders to close restaurants out there and recreational facilities. Who's going to the movies? And Disneyland, Disney World, Universal Studios, all those places are shut. So you have the whole travel-related sector of the economy shut down. And then on top of this, which we noticed earlier, the coronavirus triggered the oil price war because China got sick. They dramatically reduced their demand for oil. The price of oil collapsed. And then Russia decided to go to war against the American frackers. And that's going to shut down the whole Southwest. And it will have a big impact in Ohio and Pennsylvania, where there's a lot of fracking going on as well. And that's going to severely reduce the demand for oil field equipment, which is a big deal.
Right. And, one talking point that we keep hearing throughout all of this is that, the fundamentals of the economy are strong. And once this does pass, we'll bounce back and things will be stronger than ever. I mean, does that look a little bit too cheerful right now? Or what is your assessment of that?
Well, we don't have a huge bounce back. We could come back with 4% in the fourth quarter of the last run, but then slows back down to a 2 to 3%, 2 to 3% clip. The thing is, it's going to depend how many things get broken in the economy, how many restaurants don't reopen, how fast does travel come back, what happens to the price of oil, what happens to the whole oil and gas industry. This is going to take time to sort out. When will overseas tourists be willing to come back to the United States? And that's very important for California, because one of the reasons why we have California hit harder than the rest of the country is it's the import-export, the logistics business, and the ports, and then it's a huge tourist economy and a huge entertainment economy. And Hollywood is shut down for all practical purposes right now as well.
I have a lot of friends asking me, is this just like 2008? Do you see any similarities between that economic meltdown and what's happening right now, or what's different about today?
Well, what's different is the banks are in much better shape. But what else is this is an unprecedented shock, because we basically have a public health emergency morphing into an economic emergency. And it is really happening much faster than 2008, because if you recall, 2008 crisis began in August 2007 when the financial markets started to seize up. It took another year before Lehman failed, and then things fell down. So this is potentialists could have much more widespread unemployment this time than last time, and that's why both the Fed waited 3 months after Lehman before going to zero rates. Here they waited a couple of weeks and they went to zero rates and QE. They're doing it all much quicker, and the Congress is acting apparently much quicker. So hopefully something will pass
And do you think that some of that stimulus and the fact that the Fed took so much quick action, are you hopeful that that will help? Because I've also been hearing, that all the arrows that they have at their disposal have kind of been used.
It's going to be much more in fiscal policy, but the Fed can certainly put a lot of lubrication into the financial system, which it desperately needs, and is doing that. So it could prevent things from really getting worse. So that's one thing I think that the Fed could do. Whether it could make things better, that's not clear, because lower interest rates is not going to get you to go to a restaurant when the restaurant is closed. And lower interest rates isn't going to tell an entrepreneur, hey, the cost of capital is lower, I want to open a restaurant. So that's not going to happen either. So the job of the federal government is to make sure that United Airlines, Delta Airlines, Boeing, you go down the list, a bunch of hotel companies, a bunch of restaurants, small and big, they don't break and they don't fall apart. Because if these companies break, that's when it's going to be very hard to come back. If we could keep most of the things together, and we also have to keep income together for all those folks who need, if they're being laid off because of this or they got sick, is they need money to meet rent payments, meet car payments, meet mortgage payments, pay off their credit cards. And you don't want to see a raft of personal bankruptcies coming up out of this as well. So it's going to take a lot of money. It will probably be more than the 1.2 trillion that Washington is talking about now.